Hello and welcome to our Construction Market Trends webinar hosted by Skanska USA Building. I'm Katie Wilson, Senior Director of Business Planning and Strategy, and I have the pleasure of being your moderator today. Thank you all for joining us. We would love to know what part of the country or what markets and industries you work in, so feel free to let us know in the chat. This webinar is meant to be accompanied by Skanska's quarterly market trends report that covers supply chain trends, material pricing, labor changes, and other related construction industries. We'll drop the link to the report in the chat. Please be sure to check it out after today's webinar if you haven't already. Now, I'd like to introduce our speakers for today.
Hi, everyone. I'm Kez Ganiting, and I'm a National Supply Chain Manager here at Skanska USA Building.
Jay, you're on mute.
Jay, yeah, we also can't hear you, Jay.
I can't believe that was a rookie mistake. I apologize. I'm Jay Bowman, partner at FMI. I lead our research and analytics practice and really just help leaders in our industry decide where to grow, what to offer, and how to compete.
And good morning, everyone. I'm Steve Clem, Senior Vice President of Pre-Construction and Project Planning, representing the West Coast.
Good morning, everyone. Senior Vice President of Pre-Construction, Chris Hillier, and I oversee our central regions, including Texas, Tennessee, and Ohio.
I'm Will Center, Senior Vice President of Pre-Construction here at Skanska, representing our Mid-Atlantic and Metro regions on the East Coast from North Carolina up to New York.
Awesome. Thanks, everybody. We have a packed agenda today, given how we're addressing market conditions and the continued uncertainty around tariffs, policies, inflation, and the Federal Reserve's potential rate cuts. We'll start first with Kez, who will dive into supply chain and materials, and then Jay will join us to provide an overview of the current macroeconomic landscapes and impacts to the construction industry. And then we'll conclude with Will, Chris, and Steve, who will discuss differing local economic trends across the country and provide examples of how our teams are navigating market uncertainty. If at any point you have any questions to our speakers, please add it into the chat. We're planning to have a Q&A at the end of our session. If we can't answer your question in the time we have allotted, we'll be sure to follow up with you directly. Finally, know that we'll be sending a recording of this webinar and the material to all of you. With that, I'd like to ask Kez to dive into our supply chain and materials update. Kez?
Thanks, Katie. Happy to be here today and give our update. So on this first slide here, what we've done is summarized some of the key themes that we're seeing in tariffs. First of all countries are currently subject to the product-specific tariffs. Those are called out in the blue box up at the top corner there. Steel, aluminum, and copper are all facing that 50% tariff rate. We've highlighted below 4 of our key trade partners: Canada, Mexico, China, and the European Union. They make up about 60% of our trade using numbers from 2024. And I just want to walk through the current state of tariffs for these 4 partners. So Canada, we got about 12.6% of our material from them last year. And currently they're subject to that 35% base tariff rate. Obviously, there is an exemption for USMCA compliant products. One thing we've called out here is the lumber tariff. That has actually increased since we last had our webinar. It's 35.2%. Now, this number looks scary, but since housing starts are down and that is a key driver for demand of lumber, that's not too concerning to us at this time. Stepping over to Mexico, we've got 13.4% of our imports from last year came from there. All goods have that 30% base tariff, with the exception again of USMCA compliant products. China, about 15.5% of our imports came from there last year. All goods have that 30% base tariff, but just note there's a lot more tariff options available, if you will, and these rates can vary significantly, but that's the base rate you'd be looking at. And then the European Union, with 18.6% of total trade volume last year, has about 15% tariff, has that 15% reciprocal tariff rate. And then just looking at the construction materials that are coming in from these countries, we've listed them out here. We're aware of what's coming in and we're just tracking and monitoring that. So on the next slide, we have our typical slide here, right? Our forecast for material cost and availability. So generally what we have seen is lead times have continued to stabilize and even trend downward in some instances. The first column here for mineral wool, we've continued to see improvements. We reported out in our January webinar that lead times were 16 to 32 weeks. That has continued to drop down. So the one sort of challenge area there is 10 to 12 weeks now, and pricing is between 5 to 8%. Roofing products, those are stable as well, and we're anticipating escalation to be in line with what typical annual escalation would be, that 3 to 5%. When we look at HVAC equipment, lead times there are down, but there's a couple things to note here. Manufacturers have continued to invest in capacity, so that's eased up the lead times a little. However, this could change depending on where interest rates go. Escalation is up just a little, 10 to 12%. That is significantly revised from what we had initially forecasted earlier this year. When we look at electrical gear, I wanted to call out this category. Although we do have that downward arrow on the lead times there, we're still seeing escalation of pricing, significant escalation of pricing, which is worth noting. And also lead times are still extended for generators and transformers. Now this is due to data center demand. So we don't anticipate those dropping off too much. And then for copper wire, those prices are up 20 to 30% on the year, and aluminum wire is up 40 to 50%. So this is pretty significant, and that ties back to those tariffs that we talked about earlier. Wood materials stable, pricing is up slightly. Structural steel lead times are stable with pricing up about 8 to 12%. When we look at plumbing, just on one last thing I wanted to talk about for plumbing. We are seeing some interesting things happening with copper pipe. The lead times there are significantly extended, 12 to 28 weeks, depending on where you're sourcing your copper pipe from. And the pricing there is 35 to 45% on the year. And again, because of the tariffs. So on this slide here, generally the big picture for the categories here, lead times are stable, pricing is up, but not too much. But there's two categories I wanted to call out: curtain wall and aluminum glass, and electrical commodity materials. So for curtain wall, that category is up about 10 to 12%. And this is again due to those Section 232 product tariffs. And then for electrical commodity materials, medium voltage cable has extended lead times, and this is because of data center demand again. And then steel conduit, we've seen significant price escalation on that this year, 15 to 30%. So those are just two things to be aware of. So on the next slide, I wanted to dive into the copper tariff a little bit, because this is the latest thing that's been going on. So when we look at US consumption of copper, we produce about 55% of the copper we use domestically each year. That means 45% is being imported from these other countries listed out here on the slide. And that's a concern depending on what tariff rates this product has. So looking on the next slide at the sort of what's been going on with copper from an inventory perspective, it's been talked about that there was going to be a copper tariff since at least back in November of 24. And that finally became official in early March that the investigation was underway. We've called out on this slide when the investigation was announced, because as you can see, there was speculation leading up to that, and copper inventory levels increased significantly. In fact, this year and the first half of the year, double the amount of copper was imported than was consumed. So there's a lot of copper inventory in the US at this moment. On the next slide, we're looking at pricing of copper per pound. Similar story here. Pricing has been trending upwards. The investigation was announced at the end of February. It was initiated. Prices continued to escalate upwards. However, when that 232 tariff was announced, there was some surprise exemptions included there, which I'll talk about on the next slide in a moment, but that basically caused pricing to collapse. Pricing dropped 20%, which was the biggest decrease in pricing in almost 40 years. So in the next slide, we'll illustrate why that happened. Well, as it turns out, with the exemption that was announced, 83% of our copper imports are excluded from that. So we've got the picture there shows our copper cathodes. That's a key input for manufacturing copper wire, tube, those kind of things. That's exempt, as is copper scrap. So 17% of products we're importing will be impacted. That is copper wire, rods, sheets, tubes, that kind of thing. So the current state of this tariff on copper is less severe at this time than traders had initially thought. So in the short time, what this means for copper is pricing is actually stable right now, but this is something we're actively continuing to monitor as this landscape is changing every day. And we'll be reporting out on that as we see changes.
All right. Thank you so much, Kez. If you have additional questions for Kez, please add them to the chat and hang on for our Q&A session at the top of the hour. Now that we have an understanding of the supply chain and materials, let's dive into the economic landscape to understand the bigger picture and how the economy is affecting the construction industry. Jay, welcome back.
Well, thank you, Katie. Appreciate that. I often say that bull and bear markets exist at the same time in our industry. And that's really because construction in the design industry is just so fragmented. There's always growth somewhere. I think the challenge is knowing where to look and how to move quickly when others tend to hesitate. And that's the lens I'll use we use today as we sort of walk through the data, what the overall market looks like, where the growth and risk really are, and how those forces are shaping the opportunity. So if we look at our Q3 forecast, this is FMI's latest construction put in place forecast. We're looking at non-residential and non-building construction spending. And we say non-residential, this excludes single family, multifamily, and residential improvements. So we're really talking about the types of projects that would fall into the commercial, industrial, sort of institutional sector, along with non-building, which is just the census word for what we would consider heavy civil. So highways, power, and water infrastructure. And our current forecast shows about a $1.2 trillion level of spending for 2025 in those two sectors, non-residential and non-building, growing at about 3% per year in nominal terms. But much of that growth, as you might expect, is really driven by inflation. So when we adjust for inflation, looking at that orange line, the market's basically flat. We have a slight dip through 2027, followed by a recovery. But the important point being that even though it is flat, this is still a massive market for the US. And spending levels, even at flat levels that we see over the next 5 years, are comparable really to what we saw, or even higher than, say, 21, 22, when people thought the market was great. Now, I think we have to think again about how that segments out. So as we look at how that breaks down in the next slide, now that 3% overall really mask the differences we're seeing across sectors. So two segments that we tend to think of in terms of growth, data centers and manufacturing, because of sort of the historical precedent that they've set. Data centers continue to lead growth at about 13% per year through the next 5 years. So I would say that that growth rate could actually be higher if it weren't for some of the power and water constraints that are kind of keeping that tempered. Now, manufacturing, which has been really the standout segment of the last several years, growing almost 200%. Think of it in terms of going from 5% of total construction spending in the US to now 1 out of every $10, being just huge, looks really flat at almost 0%, 0.2%. But I wouldn't dismiss that. That's still over $220 billion annually. And if we compare that to lodging, which looks like, a really good market at 8.5%, not to put down lodging or anything, but that manufacturing, even flat at $220 billion annually, still 10 times the size of lodging, even though it's growing at that. Now, I did add multifamily back in there. I tend to think of it as a commercial, and it's sort of right there in the middle, that 4 to 5% range. So I think the takeaway is not just about growth rates, although that does kind of show where that 3% is masking things, but it's also about the size of the opportunity. So a smaller market growing fast still may not add up to the scale of maybe a larger market that's not growing as fast, like manufacturing. If we shift also to geography and look at what does this construction spending look like across the 9 census divisions, the South Atlantic still remains the largest market at $1.2 trillion, with Texas and sort of the West, South, Central sort of right behind it. Now, the bubbles here just represent the comparable size in spending over the next 5 years, and then the colors just the growth. So what you'll see then is that the Middle Atlantic and the East, North, Central, so think New York, Pennsylvania, Ohio, Illinois, sort of Great Lakes area, are smaller in size compared to the South Atlantic and West, South, Central, but actually growing fast, around 6 to 7% or so over the next 5 years. Now, I think an interesting note to this is that data center incentives are being rethought in places in the South Atlantic and some other states as well, which have been a big driver of construction spending. So these projects tend, obviously, we know, consume a lot of water, a lot of energy, but don't necessarily create many permanent jobs beyond the construction. So we're seeing some pushback, whether it's removal of tax incentives, maybe super user rates, that we think is shifting some of that growth along with some of those other super users like semiconductors, et cetera, into some of those areas in, again, the Middle Atlantic and the East, North Central, which are kind of creating that disparity in growth. In fact, frankly, the only region that's showing any outright decline is the Mountain Division at -1%, but that's coming off sort of tremendous growth they saw over the last couple of years. Now, I do want to touch on the tariffs and just kind of build off of something that Kez talked about, which I really appreciate. And I think it's important in many cases when we think here at FMI from an analytics perspective is how do we frame this in context? So for almost 90 years, the U.S. policy was moving towards ever lower tariffs, whether through like the GATT, NAFTA, basically trade liberalization. So I think the real shock is not necessarily the level of the tariffs, is the fact that it's so different from what the precedent was over the last 90 years. Now, low tariffs definitely had benefits to it. So lower cost means that owner budgets stretch, they could do more. Contractors could, have more competitive bids. It opened up the supply chain, even innovation, you could say. But it's not necessarily a linear line that lower tariffs are always best and high tariffs are always great. It's more like a curve, and we just don't know where on that curve it is. So we could also think of sort of the negative aspects of 90 years of potentially low tariffs, the loss of domestic manufacturing, and with that, sort of the removal of vocational education in our schools and sort of the policy that every person needs to go to college. And then through COVID, we learned just how fragile a global supply chain could be. And when we think about what's the major challenge that has really impacted the design and construction industry over, let's say, the last 50 years, has been a shortage of skilled labor. So I think the right question isn't, are tariffs good or bad? It's what's the right balance point? And that's what we're really, I think, working through now and probably over the next year or two, is how that balance really shapes cost, how it's going to shape our supply options, and even sort of where sector resilience is. So if we then think about it from that standpoint and what the impact is, because I don't want to say that tariffs don't matter. They obviously do, and I think Kez made a good point with that. But we have to go back to also thinking about, well, how do they impact? Meaning, when owners decide to build, I think it usually comes down to one of 3 reasons. They're either enabling a service, producing something, or seeking a financial return. So through that lens, I think it helps us see things differently from a resilience standpoint and which segments may be more at risk when it comes to tariffs. So I think the resilient sectors over the next couple of years include infrastructure because of public funding, plus manufacturing, healthcare, and data centers. Whereas those that might be more at risk are projects with a very strong financial component, meaning these are owners that are building in sort of in search of a financial return, and tariffs obviously throw those off. So office, retail, for rent residential, mixed use, all those segments that are really sort of highly sensitive to cost and capital availability. So I think tariffs are part of the picture, but the fundamentals, why the project is being built in the first place, matter even more. So I think it's good to put those things into context. So finally, I think, what do people in our industry, what are they feeling as a result of this? And so these are some of the major sentiment indices that I follow. The Architectural Billings Index, FMI's Non-Residential Construction Index, which is sort of similar to the ABI, but for contractors. Our Civil Infrastructure Construction Index, I think of that the heavy civil one. And then the CERT Index, which is sort of the largest designers and contractors, or several of the largest designers and contractors in North America. So what our architects and contractors are doing is really signaling contraction. So anything below 50 suggests that, that there's less confidence in the market going forward. So the ABI for the prior month that was available, it was at 44, declined to 43. So more negative in terms of outlook for the future. NRCI 57 down below that 50 line to 44. And even the civil infrastructure, even though we said that's one of the resilient areas, is still above 50, but in the wrong direction, if you will. So all these tell us that confidence is slipping, but I think the silver lining in all of this is that when contractors feel less confident, they may bid more aggressively. So we may see either better pricing from specialty trade contractors, owners may even see sharper pricing from contractors, which could actually create some near opportunities to move some projects forward that may otherwise get stuck. So I think just to sum it all up here, I think the overall spending looks flat in real terms, but opportunities, as we've seen, really differ dramatically by both sector and by region. And policy shifts like tariffs, those are changing the cost structure, but I think the fundamentals still drive whether a project moves ahead or not. And so even in uncertain times like these, sentiment points to a window where I think opportunities still exist and owners may be able to really truly capture real value in the market going forward.
Awesome. Thank you so much, Jay. Very interesting. And again, if you have additional questions for Jay, please add them to the chat. We're now joined by Steve, Chris, and Will to understand the differences and opportunities we're seeing across the country. So let's start. Okay, there's so much uncertainty, as we just heard, in the market and mixed economic signals. Have you seen an increase or decrease in competition from other contractors and among subcontractors in your market? Will, why don't we start with you?
Yeah, so I mean, I think if we look at the big picture and compare to where we were, 12 months or so ago, we're certainly seeing an increase in competition, particularly for attractive projects across the East Coast region. Now, when I say attractive projects, what does that mean? I think certainly having secured funding is a big deal in today's uncertain environment. Collaborative delivery models, that certainly helps. I think the other thing that's important to keep in mind is that, that is a little bit of an overgeneralization. It isn't totally consistent across the board. Jay did a great job of working through some of those variables. Just an easy example with the growing impact of data center and manufacturing work. Those projects draw more on the mechanical, electrical, plumbing labor. So in markets where there's been much more activity in those sectors, we've seen more impact on the MEP trades as a result. Some of that increased competition may not be as prevalent in the MEP trades as we've seen in some of the civil, structural, architectural trades. So I think it's important to acknowledge some of the regional variation that's happening across different markets.
Thanks, Will. Chris, what have you been seeing across your region?
Yeah, we also have seen an increase in subcontractor bid activity, really in all markets across the Central, which is a good thing. We've seen more competition in tighter bid ranges. I think on projects where we might have seen 3 or 4 bidders, now maybe we're seeing 5 or 6, but that doesn't necessarily always translate to reduced costs. It has helped offset some tariff costs in some cases where the impact that the project receives might not have been as much as we would have originally expected. So that's good. Similar to what Will just said, however, the MEP trades, that's a bit of an exception, right? So I think we've seen some momentum in the coverage there as well. But in lieu of maybe 5 or 6 bidders, maybe instead of 2, we're up to 3 or 4. So I think in general, again, to count on what Will is saying is that things vary, but we are seeing some increase across the central.
Yeah, that makes a lot of sense. Steve, we've heard a lot of companies are pulling back in Portland with layoffs. What effect will this have on the local market in the Pacific Northwest?
Yeah, good question. The tech sector is more than just individual companies. It's an entire ecosystem, supply chain, known up here as the Silicon Forest. Its counterpart to the Silicon Valley. Those changes are sending ripples through that entire the supply chain and community, and it impacts more than just construction. These are some of our largest employers, and that tech investment drives not only construction but tax revenue, which can lead to other projects, and of course, the impacts on unemployment and employment. This whole ecosystem of suppliers, restaurants, cultural attractions, they're all tied to the success of these businesses, and that needs to be considered more than just numbers, obviously. And that is causing uncertainty. I think that's the word of the year so far. It's causing uncertainty in the growth of those organizations, as well as how suppliers to those larger firms project and forecast their growth. And so all of that is affecting project starts and causing them to be more uncertain, or to be scaled back to be the bare minimum instead of more ambitious projects. On the healthcare side, we're also seeing some of that impact. Local research hospitals, some of the bigger employers here in the Northwest, feeling the pinch of reduced federal funding, and some of that doubt has led to uncertainty for larger projects. It's leading to owners having to be more creative about how they fund projects, which ones take priority, as well as leading to recent cancellations and proposed mergers of large healthcare systems. So lots of trickle down effects.
Yeah, a lot of shifts happening there. So I'm assuming you're seeing an increase in competition as well. What results are you seeing?
Yeah, it's as Chris and Will are talking about as well. There does seem to be a little bit of have and have-nots in the subcontractor community. Some trades or specific companies are still full. They still have a strong backlog. Others have worked through that backlog and are being more aggressive. In fact, we recently bid a K through 12 project in Seattle, and the subcontractor bids in aggregate came in about 10% below the prior estimate, which was completed, or the estimate was completed earlier this year. So, and then on the GC or construction management side, these attractive projects that Will described, they can see double-digit lists of teams that are going after them, and those are all the A-listers in the region, and that's driving general contractor and construction management fees slightly lower as well.
Yeah, interesting. Will, what are you seeing in your region in terms of response to the recent tariffs? I think Jay did a great job of kind of highlighting why people are really building. So it's just interesting to see how tariffs are affecting different industries. What trends are you seeing there?
Yeah, I mean, I think an important first thing to acknowledge is just that the majority of our markets along the East Coast have seen a good number of significant projects be delayed or outright canceled as a result of tariff uncertainty, overall economic conditions. And that, as Jay said, has led to trade partners being more aggressive in their pricing. I think Steve Stouthammer shared on one of our previous webinars our tariff calculator that we use on a number of our projects. And we've seen multiple scenarios, much like Chris just mentioned, where we can quantify and calculate a potential tariff impact on a project, but when it comes time to get competitive bid pricing, much of, if not all of that potential tariff impact is getting absorbed somewhere earlier in the supply chain, whether that is through manufacturers not passing along that price increase to their subcontractors or subcontractors offsetting increased material pricing from tariffs with reduced bid margins. And at the end of the day, the pricing to an owner is in line with where it was previously, and that tariff potential impact isn't actually materializing. So that's something that we're seeing fairly consistently right now. I will say, in some markets like New York City, we're starting to see more subcontractors pushing back on taking on tariff risk and wanting to add contingencies to their bid to make sure they're being compensated for potential future changes in tariffs to manage that risk a little bit. I think a lot of this has come down to how much individual markets have been sort of stabilized by some of these growth sectors that have been more resilient, right? The mission critical work, the manufacturing, the pharma work, where those sectors or those project types have kept local markets more robust and busy. Those trade partners are busy. They are less willing to take on tariff risk, less willing to price work more aggressively. So there is a little bit of a chicken and egg here too. Certainly on the manufacturing and pharma side, along the East Coast, there have been a number of investments announced in the last few months. As those projects become shovel ready, again, that will suck up more subcontractor capacity, which will, again, limit the number of subcontractors who are ready to give aggressive pricing, right? It may limit the extent to which manufacturers continue to absorb some of those tariff impacts and don't continue to pass them on through the supply chain. So, that's going to be a key consideration. Data centers as well, of course, along the East Coast, we have a number of data center hubs that are hotspots. We've got the visual here. So certainly, that's continuing to be a key consideration. And I mentioned earlier, that has an outsized impact on certain trades. So, electricians have had a large demand on their workforce. So we continue to see, that is a trade where it's just less likely to see advantageous bid results in the electrical trade because they continue to have just huge demand for their workforce from these data center projects. And we're expecting to see a similar trend with mechanical contractors as well as some of these data center projects start to shift to more water-cooled designs for energy efficiency. So those are some of the things that I think we're monitoring in our region.
Yeah, definitely. I think it's really been a change with that AI and the surge of data center construction across these regions, as we can see with the semiconductors as well. Steve and Chris, how is this impacting your regions?
Yeah, I mean, as you can see, again, the visual, there's pockets across the U.S. And mission critical projects, of course, tend to follow where energy is affordable and where there's available land. And North Texas is a hub where it offers both in abundance. And I think that North Texas, Dallas-Fort Worth Metroplex stands out as one of the top mission critical markets in the U.S. right now. And weekly, we're hearing about seeing massive scale opportunities ranging from 500 megawatts to several gigawatts. And that translates into multi-billion-dollar developments. These types of projects, I think it was mentioned several times, they put a significant pressure on the skilled labor market, particularly in the electrical trades. If I think about the DFW area, we've added thousands of construction jobs, yet still labor demand continues to outpace supply. So, this translates to a few things, of course, right? Rising costs. When everyone's busy, costs continue to climb, and we're seeing that. Extended lead times. Kez talked earlier about the large scale equipment, particularly on electrical gear, still remains a challenge. And mission critical itself is a driver of those lead times. And so that's an impact. what we're seeing is kind of continued growth in the tertiary markets surrounding it, meaning manufacturing and just keeping the sectors that are related to the to those key markets in check to help meet the demand. And then specialized subcontractor availability, right? These subcontractors are becoming more selective. This could have longer term implications. It means that we as an organization have to and have identified trade partners early to make sure that we're getting commitments from subcontractors early. In San Antonio, actually, we're experiencing a surge of mission critical work as well. And there we've seen where some major subcontractors from the electrical side have actually migrated to help ease the strain of the market and help offset just the need. One more thing I want to talk about is just this interesting dynamic about this whole thing about electrification and how we're going in that. And if I think about the Houston market, which I'm a part of, and that the polarity between oil and gas and electrification, and we're seeing like this fight of sustainable energy versus oil and gas, and expenditures are actually down on the oil and gas side as they work to kind of offset what we're seeing in terms of a big push.
Yeah, I would just adding, to all those great comments, that the West is similar, and I think the traditional picture of a data center in a dry, arid location that's kind of barren, but right next to a hydroelectric dam, I think springs to mind for folks in the West. Places where practically giving away power. But those lead to some of the challenges that Chris was mentioning with availability of labor. The other thing that drives data center location is availability to high-speed fiber networks. And the fiber network, although it's nationwide, it's not the connections and hubs are in specific locations, and they probably not surprisingly mirror where a lot of these large dots are on the map, and that's going to continue to drive where that investment is made. Also, as Jay mentioned, there are changing attitudes towards data centers as far as sort of their initial tax or ongoing tax revenue versus their job creation. And so there is starting to feel some pushback from local communities about the general the benefit of them. And then two other things, just quickly. One is the availability of electricity is really driving the conversation. In fact, the competition between the desire to have electric vehicles in California is driving a strong conversation around, is there enough power for both priorities, data centers and fleet electrification. And so in some cases, that's causing some of those larger consumers to flee California and look for other Western states that don't have as big of an investment in fleet electrification. Then lastly, I guess the safety valve would be, how else do we create power other than just hydroelectric and natural gas or other sources. And in the news has been some of the data center operators partnering with some of the rebirth of nuclear power and seeing how that might be a mitigating factor in the power crunch. And then there's a lot of technology, especially coming out of Oregon with small modular nuclear, which could be, obviously regulations are easier to overcome that way. The time to market is much faster, and there's a potential solution there that would be relatively clean, but also eliminate some of the strain on the grid.
Yeah, definitely. I think it'll be really interesting to see how the energy and the data center kind of shapes the future there. What are you seeing across other markets for higher education and healthcare sectors? How are they impacted by current political and economic conditions? And let's see, let's start with you, Chris.
Yeah, sure. Will mentioned along the East Coast that he had seen a lot of cancellations. I would say in the Central, not so much. What we have seen is delays, particularly in education and healthcare sectors, and they're in the wait and see mode, right? I think that there's concern around the executive orders and how they might have put funding in question. So there's definitely a hesitancy on where to go next. I think we've seen some instances in Nashville, for example, where private universities have been land banking around campuses and holding on to land for future potential expansions because they're just not sure now is the right time to move forward and want to wait a little more before when the market is a little more certain. So that's kind of what we're seeing in the Central.
I think wait and see is a good term there, Chris. And I think in our region, particularly in higher ed and healthcare, I mean, in the healthcare side, just in the last few months, we have seen a few of the larger capital projects start to get cut loose in the planning phase, which is a positive sign. Higher ed's been a little bit trickier. I think certainly on the public side, we've seen funding get put on hold multiple times now. I do think some of the private institutions, particularly the top tier institutions, have started to cut loose more of their larger capital projects into planning as well. So, starting to see some positive signs there, and that may, sort of tie back to what Jay mentioned earlier, as folks are starting to get a little bit more comfort and stability around understanding the new economic climate, tariff conditions. There is a little more confidence in starting to move some of those projects forward, at least in the planning phase.
Yeah, I mean, we've seen, as I mentioned, a reduction or uncertainty in federal funding for healthcare, especially in the research side. But it's been refreshing to see private individuals and private organizations step up to kind of plug the gap there. As us Oregon Ducks like to call him Uncle Phil, Phil Knight with Nike, recently gave what's considered one of the largest gifts ever to a public education institution, $2 billion to Oregon Health Sciences University, that will further cancer research. And so that comes with potentially less regulations or less sort of directives towards how it can be used. But also, those private donations are really passion projects from the donors, and so there are some restrictions there that are different. So that won't fill the gap, but there is positive signs that individuals and organizations, charitable groups are stepping up to plug some of the gap.
Well, that's great to hear. Between funding uncertainty, economic trends, and tariffs, it sounds like there's so many factors at play here. How do we look at those at the project level? I think, Will, we were talking, you had a really good example of this.
Yeah, well, I think sometimes you can sort of simplify it a little bit into some big pieces, and we can start with kind of the typical baseline escalation that we're used to seeing, and I think we've shared a little bit in past webinars about how we look at that with our Skanska index. And then, we've got the direct tariff impacts, your 50% tariff on steel or aluminum, for example, and the indirect tariff impacts where, a domestic manufacturer might increase their pricing just because a tariff has been imposed on imported materials in the same category. And we've talked through those with our tariff calculator on how we can quantify and get our arms around those. But the piece that I think we have to start really understanding and monitoring is this kind of local market factor. And I think it ties back to what Jay was mentioning in his sentiment analysis, where understanding what's happening in that local market, how aggressive are the subcontractors going to be, what does the local backlog look like, it has a big impact on how aggressively trade partners are going to pursue projects, and can either continue to snowball on what escalation is going to be, or it can start to offset some of those tariff impacts, particularly as there's growing uncertainty in the overall economic climate. Subcontractors will want to fill their backlog, and may pursue projects at significantly reduced margins, and that can offset some or all of those tariff impacts, even offset some of the baseline escalation and keep things flat for a period of time. The reality, though, is that those local market factors can change very quickly. If you get a few big projects cut loose in a market, suddenly people's perspective on the future changes. So I think this is an example of where really being in tune with your local pre-construction leaders, having a pulse on the market is critical to just staying dialed in on what the local market condition is and how that may either add to or offset some of those direct tariff impacts. And it's not unlike some of the analysis we did back during COVID, where we were doing local market studies to understand how the trade contractors were responding to the COVID uncertainty, and how they were either pursuing work more aggressively or less aggressively because of that uncertainty. And so I think there's a lot to be said for really being hyper aware of those local market factors and how the sentiment in the local market can impact pricing at the end of the day.
I think, Chris, you had something to add here as well.
Yeah. I think just as another example, we're actually working through the planning phases on a large hospitality project in Cincinnati, and we've done a detailed analysis, as Will is suggesting, on what we would expect from potential tariffs. And what we've been seeing is a little bit surprising in terms of what we actually impacted on the project, right? And it's been much less, to the extent of 1% or less, when we would have expected much more. And what we think we're seeing is exactly what Will just demonstrated, in that the subcontractors and the suppliers are absorbing these costs to stay competitive, try to secure work in the short term. And this is a symptom of market uncertainty, and it's actually helping to serve as a slight stabilization in that case. So it certainly supports the concept and the practice that Will just talked about. The other thing is that we're seeing a heightened awareness in continuing to find ways to offset costs through additional efficiencies. And I think that's becoming more important than ever. And I know there was a question ahead of the webinar about prefabrication, and we're not necessarily seeing a bigger push in multi-trade prefabrication, but we are certainly seeing single trades trying to increase efficiencies through prefabrication in any way that they can. And this is particularly true for mechanical and electrical trades who are doubling down, trying to find ways to be more aggressive. And it's not uncommon that these days that 50% or more of what's brought out to the job sites has some sort of prefabricated element to it to help really make sure that they're being efficient on their costs on the front end.
Interesting. A lot of, kind of trying to make the best out of what the market is showing us. Speaking about understanding the local market, Steve, I've been reading a lot about how there's several infrastructure projects across the Pacific Northwest that are at risk of delay. How is that impacting the economic climate in your region, and does this have a positive or negative effect on other projects?
Yeah, in the Northwest, there are some long-awaited projects, especially I think of the Columbia River crossing, a bridge on Interstate 5 that would connect Washington and Oregon. But sort of across the West, there are other major projects, high-speed rail between Los Angeles and Las Vegas, and many others. What's interesting is that the projects that have some sort of deadline, I mean, I think about the upcoming World Cup, that's going to be all over the United States, but is going to have games in Seattle and then in California, as well as the Olympics in LA. Those infrastructure projects that have deadlines that are attached to them, that are much more publicized, have much more sense of urgency and continue to go. And some of the others just feel like they drag on. And these projects don't directly compete with the vertical building that USA Building does, but it does draw on a lot of the same craft workers. It affects their availability for our work, and it can add or deduct craft labor availability. It also, to me, it is it's a sign of economic health when a region can invest in infrastructure. Other people get frustrated by traffic delays or reroutes or detours, and I try to remember that that's our folks out there, being employed and contributing to the community, and put a brighter spin on it. But we have seen where contractors from the different markets, the civil infrastructure and the vertical building market, try to overlap. However, the infrastructure work is higher risk and has a different fee structure because of that risk. And so it can be harder for those infrastructure folks to just completely switch gears and try to go from building a bridge to a hospital. And obviously it works in reverse. I'd be terrified to build a bridge, but our folks do it all day long. And it could benefit folks that have, and firms like Skanska that have capabilities in both to help smooth that out, some of those potential interruptions.
Thank you. Well, thanks everyone. This is all making a lot of sense. So what does this mean in terms of advice to our customers for their projects?
I can jump in on that one, Katie. I think one thing that we haven't necessarily talked about yet, but I think is an interesting layer to all of this is just the reality that, a lot of the projects that we build, we may procure them, at one point near the end of a design process, but that project is then built over 18, 24 months. And a lot of the material that's going to that building isn't necessarily bought at that day that we maybe do a GMP. It's being procured, all along that 18 to 24 months by our trade partners. And so I think that conversation we were having earlier around the subcontractor sentiment and how willing they are to take risks, how aggressively they're pursuing projects, that's important not only in the margin or in the perspective of potentially reducing bid margins, right, for more aggressive bid day pricing, but also in the sense of how much risk are they willing to take on with tariffs. And if you're in a very aggressive market where the subcontractors are hungry, there's concern about the future, and they're providing aggressive pricing, they may also be willing to take on more risk around future tariffs. In contrast, in other markets where there is a lot of work out there, trade partners may say, hey, I'll pursue this project, but only if there's an additional contingency for those future tariffs, because I don't need to take on that risk given all the other options that are available to me. And so, in those scenarios, we've tried to advocate with our clients to consider allowances or unit price situations, not unlike what we did on a lot of projects during COVID, where, for example, polyiso insulation was escalating all over the place. So let's establish a target allowance of value for that polyiso insulation. At the time we procure it, we'll get an invoice for what that material cost was. If the final price at the time it is actually ordered for the project, if that price changes, we'll get the invoice at that point and make an adjustment out of that allowance, based on the price change. So, we've looked at opportunities to take a similar approach here on some of the materials that are potentially most at risk for impacts from tariffs. And essentially what that does is it doesn't push all of the risk onto the trade partner. And when you're in a market where the trade partners are very busy and they're not willing to take on that risk, if you try to push all the risk onto them, essentially what it means is you're going to be paying the worst case scenario, because that's what they're going to put money in to cover, is whatever they think the worst case scenario is. And so some clients want to cap their risk. And so knowing what that top end worst case is okay. But in a lot of cases, there may be an opportunity to not pay for the worst case scenario and instead establish an allowance that allows for that risk essentially to be shared a little bit more evenly, and pay for what actually happens, as opposed to having to pay for the worst case scenario. And of course, when we're in a market where things are more aggressive, trade partners may be willing to take on more of that risk. So again, it comes down to, I think, really understanding the dynamics of a local market and working through a strategy that's the best fit for an individual project based on the local conditions. Chris, did you have, I know we were talking this morning about some of your experience.
Yeah, I got something else. So one thing to forget about is, another option here is early procurement packages, right? So this is also another option to lock in pricing sooner to reduce that downstream risk. And this is not a new concept anymore. Since COVID, this has really become the norm. All of our projects across the U.S. are creating specific procurement plans, evaluating the systems, the materials that might be impacted, and when we hit the market, and in some cases it might be non-traditional types of materials or systems. We're working on a BSL-4 lab project in San Antonio, and we have an early procurement package where we're securing the air pressure doors, which are manufactured overseas, to working to minimize tariff impact, something that we might not normally have done early. So we certainly shouldn't be afraid to get creative in terms of how you evaluate the assessment to market, and that would be an advice to our clients.
Awesome. Well, thank you all so much. I'd like to ask Jay and Kez to join us once again, and we'll take a few questions until we run out of time here. All right, welcome back. So I think one of the questions we got in the chat that one of our colleagues answered a little bit, but I just want to open it up to the group. How do you see the expected drop in interest rates impacting the construction and development markets in 2026, particularly in light of the tariff discussion Jay mentioned? And do you anticipate a specific window of opportunity that builders and developers should prepare to take advantage of as rates come down? Anyone want to jump in here?
I'll start, I guess. Yes, the interest rates are a huge lever that can affect the market, and much like my comments about the infrastructure market, one of the things that the interest rate affects almost immediately is the single-family home or residential market. And I'm sure Jay's got lots of data about this, speak much more in depth than I can, but the construction materials that we use, in some cases can be dwarfed by the amount that the residential market uses when it's in full swing. So in some cases right now, the pressure on the commercial market hasn't been as great because the residential market has been not booming. However, from a commercial side, obviously there's very little commercial office and other types of construction going on because of this, for the very same reasons. So it'll be some countervailing pressures there. Great time once interest rates come down, if all the other conditions are right, to build more commercial buildings speculatively, but we could see that pressure from residential.
Yeah, I would just double click on what Steve said, and I think he's spot on. To me, I think there's three ways to kind of think through it. The first one being that I would expect rates to come down. I mean, the Trump administration has obviously signaled that is their desire, and the shift in Powell and everything else, which will probably lead to that. The question is like how much. But I think there's, the other two aspects to look at it is exactly what Steve was saying. Is what are the second and third order effects of this? Meaning that he's right that where it hits hardest is in that single family, but that's where that second order is, because, I showed that dip, but part of that dip and why it's coming back up is in that middle part. Should rates really come down, which we're expecting it to, then you see the single family start to ramp back up, but then everything else follows after that. So once single family comes back up, the commercial, the institutional, the industrial, the infrastructure behind that tends to follow as well. So I think you could see that acceleration because of that in the second half. I think the third way to think about this is also from the standpoint of, just like we were talking about the tariffs, at what point do we sort of become accustomed to that level? I mean, we go back to the 1980s, rates were significantly higher than they are now, yet construction was still occurring. It's the change in the markets with interest rates being a part of it that's the challenge. But once we sort of accustom or acclimate, let's say it that way, to levels, well, private developers can start to make the numbers work, and account for that. But that's the pig through the python. It just takes time. But I do think that we will start to see those rates. So, I mean, if I were watching it, those are one of those early signals. If I kind of look at it one way, just real quick, is that, interest rates right now is creating friction in the system. If we could get it's above sort of the, if you look at it from a prime rate perspective and what the Fed rate is, and you just add 3%. So the prime rate's in that kind of right north of 7%. What we've seen over the last 20, 30 years is that if it's in that 5 to 7%, it's sort of neutral to construction. It doesn't really ramp things up. It doesn't really slow things down. So what I'd be watching is, okay, what are the signals? How many basis points are they going to bring it down? And does it bring that prime rate potentially in that neutral territory? And then does it even further bring it into, if you start to see, well, okay, it's going to get below 5%, then I think the juice just starts running.
Yeah, we had another similar question about looking ahead to 2026, about just kind of what trends we would anticipate and opportunities, which is very similar. But the last part of that question is, and how might these trends vary regionally versus nationally? Is there anything we should be looking out for versus regional or national, and how they might kind of play out in different markets? Any thoughts here?
And if Chris was going to start, I can.
Okay.
I think it just comes down to a handful of things. Like, why do we see regional variations? And so what we look at when we're evaluating not only the long-term prospects of the market, but near-term, okay, well, how much movement should we see? It really comes down to three things. The most important one being what's happening from just a population perspective. That is the number one driver of construction activity, bar none. I mean, if you look at population growth and you compare construction to it, it is almost 1-to-1 for the U.S. since basically World War II. So net migration patterns play a huge part in that. So that's sort of hands down the number one thing. If people are moving into an area and at what rate, that's going to have a lot to do with sort of what the long-term prospects of that. The second is frankly just the business environment. Is it business friendly? Are they putting up roadblocks like what I was saying with data centers? It's not a one size fits all. It's how is it business friendly to specific sectors of the economy? And that's where this kind of third piece comes in. Well, what defines these markets? If we think of, for example, Houston and the Texas Triangle area, well, it's been kind of dominated by energy, technology, a few things. So then I kind of focus on, well, not only what's going on from a population standpoint, how business friendly might it be or not be, but what sort of dominates that sector? And is that a sector that's growing? Is that a sector that is sort of flatlining, kind of, stagnating, or is that one in contraction? I really think it's sort of the 80-20 rule. Look at just the few things that explain 80% of what's going on in the market without worrying about like every other metric you could possibly look at. Those come in at a later point when you're trying to make more key decisions, but just trying to get a general direction. I think that keep it simple is the best advice.
Yeah, and I think
So-
that net migration, has been driven, somewhat. You talk about consumer sentiment, but you also talk about sort of vibes of different locations across the country, and how different cities across different regions have recovered from some the pandemic, some of the other unrest we've had over the last 5 years, just the tumultuous activity. the back to office mandates. Some regions are recovering better from that, or making better strides. And I think, obviously that that vibrant, healthy central business district core, and that even, that perception that can take time to wear off, it drives that in migration, it drives that, that investment, it drives that growth, and that's going to be, different across not even just a region, but across different cities within that region.
Chris, did you want to chime in here? I know we talked earlier, or we talked about talking about this, but we didn't get to it. But there's just been a lot of migration to the southern states, and I think you're seeing a lot of that impact already.
Yeah, I mean, not a ton more to add that Jay and Steve haven't suggested, but I mean, being in the Texas market and being kind of the recipient of a lot of folks coming in, it's gonna. I mean, we're in some busy markets down here, and when things are busy, we certainly start to see activity and rising prices. I think about, if we look at Texas as an example, all four major metroplexes with Dallas, Fort Worth, Houston, San Antonio, and Austin have multi-billion-dollar airport expansions that are ongoing right now to support the influx of people. If I look a little further east over to Nashville, who was also, everyone wants to be in Nashville. Nash Vegas, fun town, temperate climate, right? Generally friendly from a business perspective. They're just coming off of a pretty significant what they call BNA vision, where they re-envisioned their airport, and they're thinking about the next phase. So we think about sectors that are supporting that migration growth. Aviation is certainly one that is right in the middle of that, and that we're seeing to support that.
Yeah, for sure.
And Katie, I might just jump in here too. I mean, I think in North Carolina too, another great example of where the population growth is really strong, and aviation, schools, healthcare, continue to be stabilized by that population growth. I think the thing that's maybe noteworthy is that in periods like we've had over the last maybe year or so, where there's been this uncertainty, things have slowed, as Chris termed the wait and see mode. With the population growth, the demand is still there, right? And the demand is growing, the need is growing. And so when these projects get paused, all we're doing is creating more glut in the pipeline that, once things get released, it can often hit very, very quickly and very, very hard. And I think, I think what we're really looking at is, Jay mentioned, the potential retraction of some of the data center demand as those incentives maybe ease a little bit in some of our Southeast markets. But at the same time, we're seeing, pharma and manufacturing investment. We're seeing, all of this pent up demand from the population growth that maybe hasn't moved forward in the last couple of years. So, it's going to be very interesting to see how those factors play out, because I think there's real potential that we may see a strong increase in, kind of large project opportunity, just kind of catching up from some of the work that's been delayed over the last 6 to 12 months from the uncertainty of recent economic conditions.
Yeah, that's a good point. Thanks, Will, for adding that in. Well, we're coming right up to our time here, and I don't see any other questions in the chat. So I think with that, we can probably close out. I want to thank you to all of our panelists and everyone that joined us today for Skanska's Construction Market Trends webinar. Please check out our full report with the link that we put in the chat, and have a great day, everybody. Thank you.
Thank you.
Thank you.
Thank you.